You do not need lots of cold hard cash to buy real estate. But if you really want to own real estate, that's a different story. You have to protect yourself and your investments. This is something I hear people say all the time. You can only buy real estate if you've got a lot of money. And that's just not true. You can absolutely finance a property 100% and buy it with no cash out of your own pocket. But just because you can doesn't mean you should. So today, we're going to break it down. What's up, everybody? I'm Henry Washington, and I'm filling in for Dave Meyer as guest host of the BiggerPockets Real Estate YouTube channel. Today, I'll explain the difference between buying real estate and really owning real estate, and how you need to think about capital if you want to use investment properties to build life-changing wealth. In this video, we'll cover the advantages and disadvantages of financing a property 100% so that you buy it with none of your own money out of your pocket. How much cash do you need to keep in your reserves? And one more advanced investor bonus strategy that might be the best of both worlds. Before we get into it, today's show is sponsored by Ignite Funding. Ignite Funding is transforming how real estate investors generate passive income from real estate. This investment product lets you act as the bank, funding loans for developers while earning 10% to 12% fixed returns without managing properties. Each month, money lends into your account while you do absolutely nothing. Your name is officially stamped on the deed of trust, giving your investment a security blanket other investment options only dream about. The proof? Investors have already pocketed a whopping $197 million in interest payments. BiggerPockets investors, are you ready to earn truly passive income from real estate? Well, get started with trust deed investments today and start earning 10 to 12% returns. Check out the link in the description. Okay, let's jump into this. All right, well, let's get to it. How do people buy real estate without their own money? Well, the truth is there are tons of ways you can buy real estate without your own money. You can either get a loan from a lender who's willing to loan you 100% of the money you need, so lending you the purchase and the down payment and the renovation amount so that you don't have to use any of your own money. This does exist. It takes work to find, but it exists and lots of investors do it. Or you can use or leverage what some people call gap funding, meaning you can find a lender who's willing to lend you a portion of the purchase price, which is most lenders. They're either going to lend you somewhere between 90 to 70% of the purchase price, meaning you have to bring somewhere between 10 and 30% down payment. And then you can go find a gap lender or obtain gap funding, which is someone to cover that gap, that down payment and closing costs. So someone to cover the 10% to 30%. And that's typically going to be protected by a second mortgage. So I don't have time in this video to cover all of the ways you can structure these kinds of loans to get 100% financing, but I do cover many of them in my book, Real Estate Deal Maker, which you can get at biggerpockets.com/dealsbook. The next question I want to cover is 100% financing ever a good idea? Look, there are some investors who are in the camp of you need to put 20% down every single time. It protects you. And there are some investors that say, I don't want to put anything down. I want to leverage as much as possible to help with growth. And so the answer to is it a good idea is you have to figure out if it's a good idea for you in your level of risk tolerance. Some people with a higher level of risk tolerance are willing to take on more leverage, people like myself. And there are people with a lower risk tolerance who want to put money down every time. People like Dave Meyer, right? Both of us can be seen as successful real estate investors. So there's not saying that one method is better than the other. What we are saying is that the method we chose fits our risk tolerance. So you need to understand your risk tolerance. But one thing that Dave and I will both always tell you is that no matter what, you need to be buying a really good deal. There needs to be meat on the bone. The reason I'm willing to take on more leverage and not put money into a deal is because I know and I'm confident that I'm buying a really good deal, a deal that I know I can dispose of multiple ways if I find myself in a pinch. If I'm buying a house at 50 cents on the dollar and I decide, you know what, I'm too leveraged right now, I need to unload some properties, I know I could stick one of these properties back on the market in its current condition and sell it and at least break even so that I can get out of that leveraged situation. You have to buy great deals in order to be safe. So 100% financing can be a good idea for your level of risk tolerance in the right situations if you're buying a good deal. I think a better question is, should you finance a deal 100%? Because that answer will vary from individual to individual. I do not think everyone should buy a property 100% financed. I think the draw to people wanting to buy properties 100% financed is because there are a lot of people who don't have money and they're saying, well, now I can get into an investment deal that's going to make me some money and I don't have to have any money to do it. Sign me up for that. And I would say that can get you into trouble. One of the things I always tell people is you don't have to have money to buy real estate, meaning you can absolutely 100% finance a deal, but you should have money to own real estate, because just because you can buy it doesn't mean you can operate that property if and when something goes wrong. I always tell the story. It was either my second or third rental property that I bought. I bought with almost barely any money out of my pocket. And that rental property, literally the week after I closed on it, the HVAC went out and it cost me about $6,000 to replace the HVAC. If I did not have cash reserves, then I put myself in a very difficult position as a landlord, because now I have somebody living in conditions that are unsafe. I live in a place where it gets very, very hot, and for them not to have air conditioning can be very unsafe. And so you don't want to put yourself in a position where you're forcing someone to live in unsafe conditions because you were not financially prepared to own real estate. So just because you can buy properties 100% doesn't mean that you should. I think you need money to own real estate, even if you don't need money to buy that real estate. The goal should be, you should be saving up money so you can have some sort of protection account to cover you in case of your expenses. In other words, we like to have an account that has enough money in it to take care of whatever might be the most expensive fix on a property at any given time. And so the more properties you have, the more money you need to have in that account. So if you've just got 1, 2, 3 properties, you can have an account maybe with $10,000 to $15,000 in it, and you'll probably be pretty safe, because the most expensive fix is typically going to be a roof, and a roof is going to cost you anywhere between $10,000 to $15,000. And it's very unlikely that if you own 3 houses that all 3 roofs will need to be repaired at the same time, unless there's some sort of natural disaster. And if that's the case, then you've got insurance that's going to cover that anyway. So just because you can buy property with no money doesn't mean you should. You need to have money, because you never know what could go wrong, and you don't want to put your tenants in a bad situation, and you don't want to put yourself in a tough legal situation should those tenants sue you because you're not providing safe housing, because you can't afford to provide safe housing. All right. And before we wrap up and get out of here, I'm going to talk about one more bonus strategy you can use to buy property with little to none of your own money. And that is leveraging creative financing, more specifically owner financing. When you buy properties on owner financing, essentially what you're doing is you're leveraging the owner as your lending institution instead of a bank. So typically this only works when a property is owned free and clear by the seller. And if the property is owned free and clear, then you can structure a loan from the seller for the property. In other words, I have a deal right now where we've negotiated seller financing. And what we did was we figured out what was important to the seller. When you think about seller financing, there's about 4 levers that you can pull when you're structuring a seller financing deal. Typically, those levers are how much down payment, how much the purchase price is, what the interest rate is, and then what the amortization or terms of the loan are. And the key with owner financing is to put 2 of those levers in your favor and 2 of those levers in the seller's favor. And that creates a win-win situation. And so if you find yourself you're talking with a seller who owns a property free and clear, what I typically like to say is, well, if I were to buy this property on terms, I can probably pay more for the property. When I structure seller financing, I typically want to put a few of the terms in your favor and a few of the terms in my favor. And so what would be most important to you if we were to structure buying the property on terms? Do you want the highest price point? Do you want a higher interest rate? Do you want some down payment, or do you want the loan to be a longer and shorter term? And typically they'll tell me, and in this recent situation, the seller said, well, I really don't care about the down payment because I'm not selling it because I need the money. And I don't really care about the interest rate. All I care about is what monthly payment I'm getting each month and that I'm selling the property for a fair price. And so I said, okay, well, let's structure a higher purchase price so that we can get your payments where you want them to be. And then I tweaked the interest rate and I tweaked the down payment in my favor. So I said, if I can structure a loan where there's no down payment, where there's a lower interest rate, but you're getting the $1,400 a month that you want, and the loan only lasts for about 10 or 15 years, would that work? He said yes. And so we tweaked the terms so that he got what he wanted and I got what I wanted. So I don't have to put any money down to buy that property. So that is a strategy that you can use creative or owner financing, where you can buy property with little to none of your own money. It's a little more of an advanced strategy. You're going to have to do some research before you can really crank out terms like this, but I wanted to make sure that we give you as many options as possible. All right, folks, thanks for watching today. And if you found this video helpful, please like it and make sure that you're subscribed to the BiggerPockets YouTube channel. I'm Henry Washington. I'm subbing in for Dave Meyer today, and we'll be back with another video tomorrow.